Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The first half of 2023 turned out to be one for the record books on many fronts. The question now is, what is next? This isn't the first time markets have done something like this, but it certainly is unusual. What does history tell us we should expect next? As many have written in various forms, learning history is easy. Learning its lessons is almost impossibly difficult. Let's see what we can conclude as we work through the subjects listed here. Let's start by briefly recapping what we have witnessed. All market types had major moves, but the U.S. stock market was the eye-catcher. Crypto up 52.9% in 6 months. Stocks up nearly 15%, but over 20% since the 2022 market close, placing them officially in a new bull market, if you believe these Wall Street marketing categorizations. Even cash was a performer, at least in nominal terms, while commodities across the board were not the place to have been in the first 6 months of this year. The S&P 500 is just short of retracing a Fibonacci 0.76 level of the drop we witnessed in 2022. Extraordinary by any measure. However, is this the end and we should now experience a classic Y downward leg equal to the initial W leg? It just seems too much of a coincidence, since that would give us exactly a standard Fibonacci 0.618 retracement of the entire post-COVID-19 run-up. Our longtime subscribers will notice the S&P 500 level of 3195 shown here is just about exactly our long-held 3270 target, which we spelled out in early 2022. More coincidences? Most appreciate that the S&P 500 index returns were negative year-to-date if you exclude the top 28 names. The year-to-date market cap gains of the big technology 7 was greater than the GDP of Germany. The top 3 market cap players of Apple, Microsoft, and Google, with $7 trillion of market cap, exceeded all the emerging markets with 6.5 billion people producing whatever they produce. By the way, what they mostly produce is various raw materials called commodities, which were the worst performers. I've written about the extraordinary narrow breadth of this market, only seen during the Nifty 50 era in the 50s and 60s and the dot-com bubble in the late 1990s. It all actually started in January when the news flows of artificial intelligence coincided with a sudden, unexpected surge in the markets. Our proprietary Matasi cross signaled a buy in late January for the big 8 technology players. What didn't get much play at that time is the explosive lift in NVIDIA, which occurred when we got that buy signal in the big 8 technology stocks. This is highlighted here by the circle shown. More recently, the market has been about NVIDIA, Tesla, and the gamma mem players betting the farm. I'm personally not sure how long this will last before we have a substantial consolidation to find firm support. Trees simply don't grow to the clouds. But we are close, as we've been highlighting in the weekly Matasi newsletters. Yes, artificial intelligence is only getting started, and it will no doubt be huge. But nothing goes straight up, at least history tells us that. But the markets are more than just the stock market. Rising yields have made cash a major winner. Huge money has flowed out of poorly yielding bank deposits into high-paying money market funds. The one-year riskless U.S. Treasury yield was paying nearly 5.5% on Friday. It was not long ago that number was close to zero. The overall distortions have been so great that many would be surprised to know that the flow winners have been actually cash, high investment-grade bonds, and emerging market equities. The year-to-date flow losers have been U.S. and EU stocks, tips, bank loans, and high-yield junk bonds. There is a message here. Seasoned long-term institutional investors have seen this sort of euphoria, greed, and fear of missing out or FOMO before. What do they see and what are causing the distortions and divergence in these charts? First, they don't believe inflation is anywhere near yet being under control. Those who lived through the 70s learned how difficult it is to get the inflation genie back in the bottle when negligently let loose. They look at the falling CPI, and as we spelled out in recent newsletters, this is directly tied primarily to the reduction in gasoline prices, and that was due to an exactly correlating selling of U.S. strategic petroleum reserves by the Biden administration prior to its launching its Bidenomics economic election platform. Conversely, the UK was shocked at their recent CPI and were forced to spike their rates 50 basis points, and they aren't the only ones. Inflation is still rising at rates north of 8%. Globally, we're at best in round 3 of a major 10-round fight. Central banks now know conclusively they need a recession to regain control. Treasury Secretary Janet Yellen boldly claims, and I'll quote her, "You can't have a recession with job markets being this tight and unemployment so low." End of quote. At 3.4% in April, this was the lowest since 1969. She may have forgotten, however, or needs to be reminded at least, that the all-time low was in April of 1929, prior to the most historic crash in history. In actual fact, as we've been reporting, the employment levels, as shown in the top left, and the unemployment levels in the bottom right, have now established clear monthly and weekly trends. We feel and are fairly confident that these numbers will soon abruptly and rapidly accelerate in the direction of their newly established trends. Ms. Yellen needs to review some of the charts we've been recently publishing in our newsletter, or look at this one to see how abruptly this changes. This chart shows the Fed funds rate when it reaches the neutral rate and goes on hold. As we are close to doing so, the job openings divided by unemployment level normally drops like a stone. The ratio is consistent even in prior eras, which we showed in our annual thesis paper outlining the approaching era of stagflation. The government is consuming too much of the nation's resources, as the U.S. budget deficit alone in the past 12 months is the largest in 60 years outside of recession or war, at $2.1 trillion or 8% of GDP. The proposed 2024 federal budget would make the U.S. government bureaucracy the third largest economy in the world. Though I've been mostly focused on the U.S. so far, the problems today are actually global. Germany, France, and the EU overall have serious economic problems. Japan has inflation that is crippling it and altering the Japanese carry trade that the world depends on. China is not emerging as anticipated from the post-COVID lockdowns. The list goes on. All of this doesn't bode well for the stock market. However, economics and markets are simply two different beasts, and though they track together over the longer term, the short term is a different animal. So what does history tell us? Since 1945, while the S&P 500 gained an average of 4.2% during all second halves, rising in price during 69% of all years, whenever the market's first half return exceeded 10%, the S&P 500 posted an average second half advance of 8% and gained in price 82% of the time. Since 1990, all sizes, styles, sectors, and 92% of all sub-industries gained in price in the second half following an S&P 500 rise in first half. If you believe Wall Street, it looks like first half equity performance is doing a booty call to the second. The last 11 times equities were up over 10% in first half, the market continued higher in the second half. You have to go back to 1987 to find the first reversal. So will the bull market, we are told we are now in, continue, or will the bear reemerge and continue the next leg down? History says yes to the bull market. One of the more convincing arguments seen by many is that it increasingly looks like the earnings have already troughed. This is something the stock sniffed out in late 2022 when the S&P bottomed around 3,500. This, in our opinion, is the strongest argument for the bulls. The market always tells you, if you're listening. Experienced traders also see that Citi's U.S. Economic Surprise Index is breaking upward significantly. This indicator and the S&P 500 have previously more or less moved in tandem. There's also a big camp of optimists that see a market lift coming due to the artificial intelligence revolution that many see as comparable to the dot-com boom when the internet arrived. That model suggests a relatively minor near-term pullback, then an exploding investment boom as the Fed is forced to pivot with lower rates as the recession starts to really bite. This camp, therefore, sees a hotter but shorter cycle. Unless you've been living under a rock, you are well aware that almost all economic indicators domestically and globally are screaming a dire problem is straight ahead. We've been laying these out in our weekly newsletters. We have a massively inverted yield curve signaling a recession, which has never been wrong nor as deeply inverted since the early 1980s. There is little doubt we have a recession ahead, which can be expected to pull earnings down and compress PE ratios. We have tighter credit standards with credit contraction already occurring. The commercial real estate sector is feeling it is under serious stress already. The collapse in PPI, which while normally welcome as it signals sharp disinflation, can also be seen as a precursor to a collapse in sales growth. This also matches up with other markedly ugly boom-bust periods in recent U.S. history. We also see collapsing import-export pricing data, which is also sending the same signal. Something major and bad is definitely coming. Then we have a whole world of liquidity, which again we have spent a fair amount of time on in our newsletters. The bottom line is that fiscal stimulus over the past 12 months has been enormous, but is ending. Yes, that can be reversed by changes in fiscal and monetary policy, but both work with an 8 to 12-month lag at a minimum. We think this chart shows clearly what is actually happening. Previous policy decisions to combat inflation are actually just now about to really hit. The lag is over, and we'll see the storm arrive soon in Q3 and dragging into Q4. The trend is pretty clear when you consider the gap between the real Fed funds rate adjusted by different consumer inflation measures and the estimated neutral rate. This chart shows the coincident comparisons of the aggregated shrinkage in central banks' balance sheets and the S&P 500. We can expect the current divergence to be resolved in favor of the direction of the central bank balance sheet growth. The aggregated weekly change is currently quite aggressive. The tightness is taking money out of the system and reducing bond prices and driving yields higher. We've broken some major short-term overhead resistance in bond yields as the 10-year U.S. Treasury is now trading over 4%. We have long held that 4.2% is when the equity markets choke. Time will tell, and it's near. These are trends that cannot be changed quickly, and in the case of the recent U.S. debt ceiling increase that left the U.S. Treasury general account almost empty, it needs cash fast to keep the government funded. Higher bond yields never bode well for the equity markets. Piling on debt, which will lead to an effective increase in liquidity, takes time. However, it can quickly destabilize markets. This is a central question of whether we are about to actually see a destabilization in the global financial system. In spite of everything I've said so far, here is what most are missing in our estimation. GDP must equal GDI, or gross domestic income, as part of the double-entry accounting system the whole system is based on. GDP is fundamentally about money flows. GDI is about what the money flow yield for the economy. We've got in a habit of only looking at GDP, and the government knows that. Nobody pays attention to GDI. You need to. As you can see from the Fed's reporting, historically there's been a very close correlation, going all the way back to when the system was put in place. That is until COVID and Bidenomics arrived. There is something happening that is different. According to the government's own Bureau of Economic Advisors, the GDI was negative in Q1 of this year and Q4 of 2022. That means the U.S. economy is already in a recession. Forget the GDP. However, GDP has been massaged into being positive, and in fact Q1 was significantly and shockingly increased last week in line with the launch of Bidenomics as the cornerstone of the Biden re-election campaign. I'd love to get into what is going on here as it regards M1 and M2 money collapse and velocity of money changes that are occurring, but we're almost out of time, and I'll have to leave that to our weekly newsletters. Suffices to say, you can only massage the data for public consumption so long before you run out of runway. If this economic plane doesn't lift off quickly, Bidenomics may be compared to an exploding Zeppelin. So what is likely next? It really comes down to the reality of earnings and PE compression. The S&P appears 20 to 30% overvalued based on current PMI levels. The fair value of the S&P is approximately 3126, pretty close to our long-held belief, as I said earlier, that the market is headed to 3270. There is likely to be another bout of earnings per share downside ahead through the end of 2023, followed by stability in 2024. The average earnings recession is also likely to trough nearly down 16%. Margin compression is no doubt going to be a key driver of earnings per share growth deceleration. The leading macro data points to a downside in earnings per share surprises over the next several months. Forward earnings per share growth is now negative for just the fifth time since 2000. History tells us the price downside is in front of us, not behind. What do we conclude within all these mixed signals? We still favor the fact that this market correction is only halfway through. We have another leg down to soon unfold as a result of weakening earnings, falling PE compression ratios, layoffs and rising unemployment, and bankruptcies within the zombie junk and triple C and below corporations. When this is complete, this WXY corrective structure will turn impulsive, which is positive, and the markets will enter a new real bull market in price, likely as the U.S. dollar-denominated U.S. market rises, unfortunately as a direct result of a falling U.S. dollar, similar to what happened recently in Venezuela. If we're wrong here, then the realities of stagflation will deliver and continue to deliver a downward structure, as outlined here. Many Elliott wave devotees see this as the pattern ahead. As an old sailor who has seen many storms on the horizon while plying the Atlantic coast up here in the Northeast, it is always best to prepare for the worst. Even when my set and drift suggested that we'd miss the storm or only face heightened, short-lived, tough sailing, it was always best to prepare for the worst while we had the option. It is too late when the storm hits to adjust the sails, fasten down the hatches, and prepare thoroughly. The old adage of prepare for the worst but hope for the best always guided me home to a welcome and safe haven, and I trust that it will for you too, because we are about to face some very turbulent times. As I always remind you in these videos, politicians and central banks will print the money to solve any and all problems, until such time as no one will actually take that money or it has become of no value. That day is still much in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Their chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following necessarily what has traditionally been the true and tried approaches. Do your reading, but make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.